Hi, Matthew. Thanks for coming on.
You got it. Happy to be here.
So typically when someone buys a home, they have to go out and qualify for a mortgage. And one of the biggest factors that lenders look at is the debt to income ratio, right? And so
Right.
that has to be at a certain percentage so that the lender knows that the home buyer will have enough money every month to pay their mortgage. So in a subject to transaction, it gets a little complicated there because there's the person who's selling their home. And once they sell their home, the title or the deed gets transferred to the new buyer, but the mortgage stays in their name. It gets a little tough when they're trying to go out and buy another house for themselves. Since they already have a mortgage in their name, their debt to income ratio is already going to be high. And so obviously there are ways to get around that, but I wanted to ask you if you could explain to our viewers how a homeowner who sells their house in a subject to transaction can go out and qualify for another mortgage.
Yeah. Well, first of all, thanks for having me, and I want to give some additional context on who I am. I've been doing this 20 years. I'm a branch manager. CMG as a company is I think the 14th largest mortgage lender in the country. I mean, we've got deep pockets. I love our company because I can literally pick up the phone and call the CFO if I need to get a judgment call made on something, and that's powerful for what I do every single day. If you work for a bank or a credit union, you just simply follow the rules, and if the loan is sort of outside the bounds, you're just kind of screwed. CMG is Christopher Matthew George. He's our founder, former head of the Mortgage Bankers Association. When you are a loan officer and you look at guidelines, everything that we do is driven by guidelines, and those guidelines are on the internet. Anybody can read through them. You have to be a reader. You have to know that a lot of loans literally hang in the balance by the guidelines that you haven't read yet in the footnotes. And so what I did is I pulled up with our head of underwriting and our general counsel, and I said, there's this transaction, this Subto transaction, which is happening all the time, thousands of times a day across the US. There's a way that we can exclude mortgage debt on a property that isn't yet sold. That's the big factor. So what we're seeing here on most of these Subto transactions is you've got this house, let's say it's a low equity situation, let's say it's on the market for 460, and let's say they owe 425, okay? So this is what they owe, and this is what it's worth. And you've got a client who lists the property at 460, trying to just at least get out of the transaction by breaking even. You know, by the time they pay the loan off, they pay 6% in realtor fees, and they pay closing costs, let's call it 3%. They're barely able to pay off the loan and still bring nothing to close. So these sellers are really feeling forced that if my home is not moving at the speed or at the price I need, I'm almost left, renting it out and taking a loss on a monthly basis, or cutting my price. And if I cut my price, I'm still going to have to bring money to closing, and that's what's making these Subto offers look so appealing to a lot of these sellers. Now, the way it works on the mortgage side is, okay, let's say that $425,000 debt has a $3,000 PITI payment, which stands for principal, interest, taxes, and insurance. They're essentially boxed out from buying another property if this $3,000 is hanging over their head. And so what we do is we want Subto buyers to pump the brakes a little bit. And the reason why we want them to pump the brakes is we don't want that seller to sell the home yet. It doesn't mean they can't sell. We just want to figure out what their mortgage intentions are. And here's why. If you have this property, let's say it's listed again for 460, and the debt is 425, but the rate's like 3%. Obviously, that Subto buyer wants that debt just because the rate is so good. If they go through with the sale, essentially the deed has transferred hands, and it's nowhere in the guidelines that you can cancel out that mortgage until 12 months has passed, and the Subto buyer or the Subto buyer's servicing entity has been making payments for 12 months. That's usually the only way you can get a payment canceled out, is if 12 months of proof is provided. However, if you slow it down, and let's say, I'll just give you an example. Let's say this is September 1st, okay? And let's say this is November 1st over here. What we do is we work with the seller and we say, okay, are you wanting to buy something in the next 30 to 60 days? And if they say absolutely yes, then here's how we advise them on the steps to take. Obviously, you want to spend 10 days getting a loan approved, a new mortgage approved. If we get them approved on, let's say, September the 10th, Then, once they know their approval is valid and now they can freely sell their home subject to, and we can cancel out that payment, now they're more free to go out and start shopping for homes in this 60-day window. If I'm a sub-2 buyer, I want the title to that property as soon as possible so I can figure out if I'm going to wrap it, rent it, or sell it for whatever reason. But if I tell the sub-2 buyer to just slow down and let's do what's called a lease purchase. A lease purchase is a purchase contract in its DNA with the ability to lease for an indeterminate amount of time. And if you do the lease purchase option, here are the birds that you knock out with that one stone. If I've got a $3,000 a month payment on my credit report for PITI, I can work with the seller and the buyer and have them agree to pay the buyer $3,500 a month. The reason why we always raise the rent, if you will, to whatever the PITI is plus 25%, underwriters will always apply a 25% haircut to your rental income, and after the haircut's applied, you want it to be $3,000 so that it's an even wash. But the reason why a lease purchase is better than a lease option is because, number one, you can obviously use the lease income to wash out this payment. You can also use down payment dollars. If the sub-2 buyer is giving a down payment, let's say they're giving 10, 15, 20 grand to the seller for them to then go put down on their next house. If we include it with a lease purchase, these dollars are usable funds towards their transaction right now. Normally they would not be. Normally if I give you $20,000 to sell me your house, that $20,000 normally needs to season in your account for 60 to 90 days to be considered usable funds. And if they're part of a lease purchase, the seasoning requirement goes away. So I get the benefit of having the PITI canceled out. I get the benefit of using those down payment dollars, if there are any, towards my next purchase. And so this lease purchase document is only for the mortgage that I'm doing for them. It's not meant to go into your package because it'll never hold up in a property court of law. It's not meant to. It's just meant to satisfy loan guidelines. But let's say they close on their new mortgage on October 1st. On October the 5th, you can officially close on your sub-2 sale. So we effectively do everything we need to do before that October 5th period. And then after that, you're free to take ownership. The deed can transfer hands. From that moment forward, the sub-2 buyer would start making payments to the servicer directly instead of to the buyer. When you're in the lease purchase period and the deed hasn't transferred hands yet, the sub-2 buyer needs to essentially write a check to the seller for the first month's rent to make the transaction be considered bona fide. After they close and the deed transfers, they can pay the lender directly instead of to the buyer or to the seller. That's how we do it on a sort of a 60-day chronological time view. Where I'm challenging and pushing back on some sub-2 buyers is they're just sort of trained to say, oh yeah, after 3 to 6 months of making your payments for you, you can go out and get a mortgage. And that's just not anywhere in any loan guideline whatsoever. We want to change the conversation and say, okay, if your seller wants a mortgage now, do a lease purchase for 30 or 60 days so they can get into that mortgage. And then after they've closed, then move out of your lease into your purchase option. The lease purchase document, we work with both parties to draw it up. So if I know you're going to pay $460,000 for the house, if I know you're going to give a $30,000 down payment when the time comes to execute the purchase portion of the lease purchase, I'm going to take the numbers that are true and put them into the lease purchase agreement. So that way your sub-2 contract, your sub-2 addendums all match what's on my lease purchase for my loan.
The loan guidelines that you have, is it based on Fannie Mae and Freddie Mac guidelines?
Anybody can do this. It's not just me. You're going to have underwriters and loan officers at different companies say, that sounds so shady, that's nowhere in the guidelines, and it's just not true. I could literally Google Fannie and Freddie's guidelines and show you exactly where to find it. It doesn't mean that that company or that lender is still going to do it. The reason why we get these done is because we don't have any overlays. Overlays is a word we use in the industry to where the guidelines say you can do it. We still as a company can exercise carte blanche authority to say we're not going to do that way. And that still happens. Rocket Mortgage, Bank of America, all these big firms can still have overlays that'll prevent you from getting it done. And when those deals, it's happened so many times since May. I've had sellers calling me at the 11th hour. Their lender left them at the altar because the lender thought a sub-2 sale was going to result in the loan being paid off. And so they literally approved the loan. I've had a couple of deals where they even cleared to close the borrower to go to closing. And then they realize, oh my gosh, your loan's not being paid off to zero. That totally changes the game for them, and they leave the client at the altar. And now we sort of come in and pick up the pieces. And so that's why I tell Subto buyers, even if you get another lender that says they can do it, make sure you dig in a little deeper to know exactly what they're getting into so that they're not left at the altar.
So this is definitely something that has to be considered, thought about, and done before the deal closes, right? It's not something that you can't like go and wipe out that PITI from their DTI after it closes. After 6 months, the seller decides, hey, I want to go and buy a house. I want to put in an offer. Let me go get qualified for a loan. At that point, it would be a little too late, right? Unless they wait 12 months to...
Yeah, the guidelines for Fannie and Freddie are written pretty similarly. It just says that if it's a mortgage liability, they treat mortgage debt different than like student loans and car loans. Student loans and car loans, technically anybody can pay those debts for you with 12 months proof and you can exclude them. But mortgage debt is treated a little bit more seriously. Even sometimes if you have 12 months of proof, I've seen underwriters still not approve it, because the person making the payments technically has to be a responsible party on the note per the guidelines. Some underwriters will say, you know what, if it's a servicing entity making the payments, that makes me feel more comfortable as an underwriter. But again, that's not in the guidelines. I only like to work according to the guidelines. And so because I know that if you go to closing on your Subto sale and in 12 months or 6 months, if they want to get a mortgage, you're lucky to say for sure that I can get that done by getting the 12 months proof. I'm more certain doing it my way because I've gotten it done over 100 times. Because in this case, you're effectively using rental income to offset the debt. You're not using 12 months of proof to offset the debt. You may have a seller that, number one, let's say they're in arrears and they don't qualify for a mortgage right now. Either they fell behind on payments or their credit score tanked. They may need to wait 12 to 24 months before they even qualify in general. But if your seller is on the fence, like, I might want to buy in 6 months, I'm gonna tell them, hey, if you do it now this way, you can absolutely get a mortgage. If you don't do it now and you wait 6 to 12 months, there's a chance that underwriter at that time may still not exclude that debt.
And have you seen it happen where an underwriter didn't approve a loan, even though the payments were coming from a servicing company?
Yeah, and I'll be honest, even with the community, there's nowhere in the guidelines that states if a third-party servicing entity is making your payments that it carries more weight. It just doesn't. If Sarah is making the payments for my loan and they're coming out of Sarah's personal bank statement and they're consistent and they're proven and documented, that carries just as much weight to an underwriter versus if an LLC servicing entity is paying it. You know, as lenders, we don't care who's making the payments. You know, we just want to know, is it 12 months proof and is it consistent?
So I wanted to ask also about the due on sale clause. When people in the Subto community try and go and do a Subto transaction, they come across sellers who have questions all the time. And so one of the questions is, what about the due on sale clause? Like, what if once we transfer over the deed, is my lender going to call that due? And how would you handle that?
Any lender reserves the right to call a note due if you sell the property without alerting them first. I'm of the opinion that if there's a due on sale clause, there's a 0.11% chance it could get called due. And so I would preferably call the servicing entity of the current loan and say there's a chance that we're gonna enter into a transaction here. Just note the file so that I did my good faith attempt to alert the lender that there's going to be a transfer of deed. Most lenders are not going to even do one thing about it because they know that if they call the loan due and it's 300 grand, the chances of them actually getting paid off are pretty slim. And so that's why a lot of lenders don't want to be in the property management business. They just want, if the debt's being paid, status quo, we won't call it due, and that's 99.8% of the time the way it works. I've been a part of 7,300 transactions in my career, and I can count on two hands how many of those were called due. From a percentage standpoint, you've got pretty good odds that it's not going to get called due.
And was there a specific reason for those getting called due?
Yeah, usually they were being serviced by smaller firms. So when a lender does a loan, there's a 90% chance that loan's going to get sold, and also the servicing rights of that loan's going to get sold. If your loan is sold to Fannie and Freddie, but it's being serviced by a small firm, that small firm obviously doesn't have millions of loans on their books, and they have more time and diligence to literally watch their pipeline. If they see a deed transfer hands, there's a chance that a smaller firm will call the loan due, or a credit union, or a small bank. But when you start getting into like these massive national servicing entities, it's just way less likely, because they're national firms. They don't have the ability to be property managers and foreclose. They don't want to foreclose. Number one, it's expensive. And number two, if the debt's being paid, why do you want to rattle somebody's cage if the debt's being paid?
What have you seen happen when it gets called due by those smaller firms?
They usually give you what's called a remediation period, where you can sometimes they'll even prescribe to you, hey, if you'll do one of these 4 things, we'll remove the due on sale. So for example, sometimes they'll say, hey, transfer the deed back, do a lease to purchase, or do a contract for deed. I've seen that happen several times. There's some Zooms in the Zoom vault talking about how Pace was able to cure a couple of those due on sales. Most of the time there's a fix, and sometimes the servicer will even tell you what the fix is, while still honoring the transaction that you entered into that caused the due on sale to trigger. Honestly, I haven't seen a whole lot of banks and lenders that just give you the middle finger and say, pay the debt, don't call us. I just don't see that very often.
Some lenders, they look at the creative finance transactions in a negative light. How do you see subject to transactions, and what's some advice you would give to other lenders out there?
As lenders, obviously, we're at risk for the money. And if you're at risk for the money, there's ways to protect yourself. If you have a title company willing to insure your transaction, okay, if they're willing to insure it, that's usually my legal stop, if you will. If title will insure it, they must know something I don't if I'm scared. So if they're like, yeah, this is an insurable transaction, we'll even give you a title policy saying that this is a legal transaction, that makes me breathe a lot easier if I'm lending money on a deal, whether I'm a private money lender, a hard money lender, or a huge correspondent lender like myself. I want a title policy. I'm not going to be lending out my own money, let alone my company's money, if I can't get a title policy. The loan just won't go through.
Where do you see interest rates headed during the last quarter of this year and early next year?
Inflation has slowed down, and I know it's hard to feel that sometimes. When lenders go to price out mortgage products, it's driven by other instruments on the open market, and those instruments are priced according to the future value of dollars. Obviously, future value of dollars is based on the inflation rate. Inflation has cooled off in a lot of different verticals, if you will. Obviously gas is different, housing is different, food is different, but there are some staples, we call them consumer staples, where inflation has cooled off quite a bit. There is a common belief amongst housing economists that around April of next year, we're expecting rates to fall considerably. I don't know why we are expecting rates to fall considerably. Around April, May of 21, when these month-over-month and year-over-year inflation readings started coming out, we call it the Consumer Price Index, or the PPI is another one. But the CPI and the PPI just kept going up and up and up, and when that happens on a consistent basis, we look at the year-over-year trend, and when the year-over-year trend keeps going up, rates will keep going up. The good news since May of this year is the year-over-year trend has started to come down a little bit. The reason why we haven't seen rates come down, though, is because the 10-year Treasury keeps going up. So right now we're at 4.3%-ish on the 10-year Treasury. If that starts to come down, as well as the inflation report, then expect April, May of next year we're calling it a pretty big rate event. We think rates are going to come down considerably. Obviously, between now and then, something geopolitical could happen and totally throw it out the water. We think that a better day is coming.
Let's say interest rates do come down considerably. How do you see housing prices being affected by that?
It depends on the market you're in. I'm in Dallas-Fort Worth, where I think Texas has like 3 of the top 10 markets for new home growth. A lot of new construction in Texas because we have land, and it's a little bit easier to do business in Texas. So I can tell you that if rates fall by 2% in Texas, you're going to see probably 2 million households enter into the home buying market that are right now not entering into the market at all. I think you're going to see demand skyrocket, which is only going to make another inventory shortage. We're already starving for inventory. And that's the reason why new home builders, their stock is performing so well right now. They're outperforming resales by a long shot just because there's not a lot of resale inventory. So that means that if rates come down and now you have a whole swath of first-time home buyers jumping back into the market, you're only going to get into even more hyper-competitive bidding wars. Prices are going to get driven up, and then we're in the same boat as we were in during COVID when prices jumped 40%. I'm telling first-time home buyers and even repeat buyers that are just sort of staying put because their interest rate is so good, they don't want to move into another property that's got a 7% interest rate. What's going to happen in a year when rates are low and we've got 8 million new potential home borrowers competing for the same inventory that they're competing for now? You're going to be lucky to compete at all. I'd rather make a move now and then refinance when they do drop. A lot of companies, us included, if you close with us, we'll give you a free refi in 5 years. So let's say you close on a house September 1st of 2023, up until August 31st of 2028, we're going to give you a free refi because we know rates are going to come down. We want that to be one less reason why you don't make a decision now to move. A lot of sub-2 buyers that are also doing their own investments, DSCR, cash out, fixed and flip type of loans. I'm advising a lot of clients. Normally, I would encourage investors to consider a prepaid penalty because a prepaid penalty on your mortgage allows you to get a better interest rate. Well, a prepaid penalty can get expensive when it comes time to sell or refi out of it. So I'm encouraging investors not to not do a prepaid penalty, but just give it a second thought. Maybe taking a higher rate for a year and no penalty may be a better investment than to get a low rate now, have a 3-year penalty. If you have a 3-year penalty on your mortgage, you're going to pay upwards of $10,000, $15,000 in penalties if you pay it off early.
Or your company's licensed in all 50 states.
Yep.
How can people in the Subto community connect with you or reach out to you if they have questions or their sellers want to get a loan?
Yeah, the best thing to do is go to our website. There's a link there to schedule a call. We do ask, watch our videos first. If the question is unanswered in those videos, schedule a call with us and your seller. Your seller should watch the videos because I've had Subto people reach out to me and they're like, hey, I know I'm not using you for a mortgage, but your video helped my client to close or my seller to close with me more confidently. If there's a further need, schedule a call with us and we'd love to speak into it if you need help.